1 month ago, Broadcom hit an all-time high, $495 a share. AI semiconductor revenue up 143% year over year. Record revenue, record free cash flow. Then the stock dropped 12% in a single day. $280 billion in market value gone. Over the next 3 weeks, it kept falling, all the way down to $365, a 26% decline from the peak. Then Apple signed a $30 billion multi-year chip deal with Broadcom. The stock bounced back to 400. Same company, same technology, same quarter. The market looked at it 3 times and came to 3 different conclusions. To understand what Wall Street is actually arguing about, you have to look past the earnings and into what Broadcom is building, because it involves a technology most investors have never heard of. Most people know Broadcom for 2 things: custom AI chips and the VMware acquisition. But there's a third business that almost never gets mentioned in earnings coverage, and it may be the most strategically important one. It's called co-packaged optics, CPO. Here's the problem it solves. Inside an AI data center, thousands of GPUs need to talk to each other. Today, that communication mostly runs through copper traces on the circuit board to pluggable optical modules mounted on the front panel of each switch. Those modules convert electrical signals into light, send the light through fiber, and convert it back at the other end. It works, but it's hitting a wall. The electrical path from the switch chip to the front panel burns power, generates heat, and creates signal loss. At the speeds AI clusters now demand, that path is becoming the bottleneck, not the chip itself. CPO eliminates that path. Instead of sending electrical signals across the board to a separate optical module, CPO places the optical engine directly next to the switch chip inside the same package. The light conversion happens right at the source. No long electrical trace, no front panel cage. Broadcom is the only company shipping this at scale, 3 generations deep. The first Humboldt was as a proof of concept. The second Bailey went into real testing. Meta ran it for 1 million cumulative hours with 0 link drops. The third Davison is shipping now, 102.4 terabits per second, 70% lower optical power consumption than traditional pluggable modules. This isn't a slide deck. It's in production. And Broadcom isn't building this alone. Both Broadcom and NVIDIA are building their CPO products on the same foundry platform, TSMC's COUPE architecture. That detail matters more than most people realize. To understand why, you need to know one technical detail that almost no one in the investment community talks about. When light travels through a fiber and needs to enter a chip, there are 2 fundamentally different ways to get it in. 2 coupling architectures. The first is called a grating coupler, GC. The chip's surface has a microscopic pattern etched into it that redirects the light downward, from above, into the waveguide inside the chip. Think of it like a skylight. Light comes in from the top. The alignment tolerance is relatively forgiving, which makes it easier to manufacture at scale. The second is called an edge coupler, EC. Here, the light enters from the side of the chip, horizontally. It's like threading a needle. The precision required is extreme. A deviation of less than a micron can cause significant signal loss, but it offers wider bandwidth per channel. These aren't competing versions of the same thing. They're 2 separate engineering paths with different foundry platforms, different supply chains, and different companies building on each one. TSMC's COUPE platform, the one Broadcom and NVIDIA both use, primarily runs the grating coupler route. Global Foundries, a different foundry, runs the edge coupler route. Companies like Light Matter and IR Labs build on that platform. Intel has its own self-developed path. On-chip lasers, integrated glass waveguides, entirely independent from both. 3 platforms, 3 supply chains, and the market has been treating them as one. This is where the Corning story connects. A few weeks ago, Corning unveiled a component called the glass bridge, a glass waveguide that replaces the fiber array unit at the coupling interface. It uses passive alignment instead of active alignment. It's designed to solve the precision problem of getting light into the chip. The market panicked. Optical stocks across Asia crashed. Hundreds of billions wiped out. But the glass bridge is specifically an edge coupler solution. It targets the EC route, the side entry architecture used on the GlobalFoundries platform. And even within that route, it complements traditional fiber array units for high-density applications rather than replacing them outright. Both will coexist. The grading coupler route, the one Broadcom and NVIDIA are on, uses a completely different fiber attachment method. The glass bridge doesn't apply. It was never designed for that architecture. Yet during the crash, stocks across both routes got sold together. The market didn't distinguish between the two paths. Companies sitting on a platform the glass bridge can't even reach were punished as if they were directly in the line of fire. Now bring the stock back into the picture. Broadcom's fiscal Q2, revenue $22.2 billion, up 48%. AI semiconductor revenue $10.8 billion, up 143%. Earnings per share beat estimates. Free cash flow crossed $10 billion in a single quarter for the first time. AI chip bookings in the quarter exceeded $30 billion, nearly 3 times what was shipped. Visibility now extends into 2028. So why did the stock drop 12%? Because Q3 AI chip guidance came in at $16 billion. Wall Street's official estimate was around $17 billion. But the whisper number, the unofficial expectations circulating among institutional investors, was $17.2 billion. And Broadcom didn't raise its full-year AI semiconductor target of $100 billion. For a stock trading at 65 times earnings that had just hit an all-time high, merely meeting expectations wasn't enough. The market needed a beat on the beat. Then came the Apple deal, $30 billion over multiple years for custom silicon, announced just weeks later. That stabilized sentiment, but the stock is still 20% below its June peak. So here's the tension. On one side, Broadcom is the only company with 3 generations of CPO in production. It sits on the TSMC Coupe platform alongside NVIDIA, a route the glass bridge doesn't threaten. 6 hyperscale AI customers, including Google, Meta, and OpenAI, are locked into long-term commitments. AI chip bookings are running at 3 times the shipping rate. The technology moat is real and widening. On the other side, the stock trades at 65 times trailing earnings. Gross margin compressed from 77% to 74% last quarter as lower-margin custom AI chips took a larger share of the mix. MediaTek is beginning to compete for Google's TPU orders, and insiders sold $270 million in shares over the past 3 months. When a stock requires every single quarter to exceed what was already an exceeded expectation, any quarter that's merely excellent gets punished. That's the math of a premium valuation. Which force dominates the next chapter, the deepening moat or the narrowing margin for error, is still an open question, worth watching closely, not worth rushing to a conclusion on.